Rohr here with a concise highlight early on Wednesday, June 10th, 2015. It's currently 7 a.m. U.S. Central Time, and it's interesting that the equities and govies are finally parting ways. The continued somewhat stronger data that was weighing on equities on the higher interest rates that was creating is now seeing equities bound back a bit from their recent weakness. We'll have more for you on that shortly. So, what has all this meant to the markets? And when we say the markets, we mean the equities and govies, because the short money and foreign exchange are significantly consistent with yesterday's video analysis and the write-up, and we'll mention the one notable exception being the strength of sterling. But for right now, we've got our typical hourly chart on the left, 30-minute on the right. This is still the June S&P. We will be rolling over in the next couple days, but just looking at the equivalent short-term charts for September, the liquidity isn't quite there yet to shift over. And if you are looking at September, that is trading at a $7 discount to any of the levels we mentioned here for the June. However, it is important that what this has meant to the market so far, and why we mentioned the equities are finally strengthening, is that this is up 7 at 2087 this morning. And that's kind of important because after washing out below the 2078 to 75 area early yesterday, the rally seemed to fizzle, and the bears had a window to put the market back down into that support and needed to break it to keep the downside momentum going again. As has happened out of late last week and early this week, the markets generally eroded through support during the session. However, one of the other key factors is that whereas going back to last Thursday at mid-session, when the market started confirming its slippage below 2100 to 2096 area, the hourly MACD had escaped the lower runaway band. Well, as of the recovery yesterday, it was back above it, and that late session window where the bears might have knocked the market would have been when they could have reinstituted the downside momentum once again, and they failed to do so. So now we have a market that is back up, and it shows how important the 2090 to 88 resistance, well, what was support, the 2090 to 88 important congestion range, is going to be on the way back up, because it is also at present the overall downward channel since the last hurrah high going back to Wednesday of last week, when the market traded back up to retest the failed up break area between 2119 and 23 for the last time, before it began eroding into Thursday, and even sold off after that better than expected U.S. employment number on Friday. And 75 to 78 remains the next important support on the downside. If it should remain below it at any point, 60 to 58 is the next support. And if it gets above 90 to 88, then we suspect another test of the 2096 to 2100 area is likely. That pretty much does it for the short-term view of the S&P 500.